Right, welcome back to the channel. I'm Neil. This is Neil Invests. It's been a while since I've done an update. If you're interested to know why, stick around to the end. What I want to do today is just give an update on where I am with my investment portfolio, how I'm tracking against my goal to reach financial independence by the time I'm 50. Quick look over the portfolio to see how the stocks are doing and see where we're at. So I started investing 3 years ago. I started this channel 2 years ago. The purpose of the channel is to track my investing journey for the next 13 years till I reach financial independence. 3 years has passed. So we've got 10 years until I reach my financial independence. Well, that's the goal anyway. It has been quite a difficult 3 years, as I'm sure you're aware if you are an investor. But within the last few months since I did my last update, I have passed the £50,000 mark, which is phenomenal. I never thought 10 years ago, 15 years ago, I'd get anywhere near to that number. So consistent investing is key. Even in a market like this, can build up a pretty decent looking pot. Right, let's quickly have a look on the compound interest calculator. I use this website all the time. Put a link to it below if you're interested in it. I've got £51,000 there or thereabouts across Hargreaves Lansdown and Trading 212. I'm assuming a 9% increase. That is the average of the S&P 500 over the last 100 years. So it's there or thereabouts. Could be less, could be more. And I've got 10 years left. I'm going to be investing £2,000 a month. And I'm also going to be increasing my deposits by 3% every year. More if I can. I do actually want to increase it by more, but we'll see where we get to. So that, plugging all that in, press enter. That means that in 10 years, I will have £559,000. When you look at it breaking down year by year, you can see in the next 2 years, I'm going to break over the £100,000 mark. Can't wait to do that. 50,000 was great. 100 is the next target. And then it creeps up, and obviously the deposits increase, as does the interest year over year, to a point where we get to £559,000. Now, over that time, the accrued interest is £233,000. Free money, bang. Total deposits and withdrawals, so I've had to invest £326,000 in order to do that. And that, using the 4% rule, will give me £559,000. The 4% rule will give me about £22,000 a year, which will cover pretty much all of my bills, the odd meal out, and some living expenses. That then, at that point, will mean financial independence. Now, there's a lot of ifs, buts, and whatever's in here, because 10 years is not that long in the market. Assuming a 9% return is potentially ambitious, or we could have a massive turnaround, and I could absolutely smash that out of the park. So we'll see where it goes, but that's what I'm planning on doing. Right, in order to achieve that, I've got two investment portfolios. The first one we're going to start with is Hargreaves Lansdown. This is from 2020, I think, something like that. The first year I started investing anyway. So I got £11,000 in there now. Total gain on that is £1,700. This, I haven't added anything to it, obviously, for 3 years. Ticks along nicely. Holdings in here haven't changed in any way. If you watched this channel before, they all look the same as they have before. Let's get a total in place. Press total, and we can see that I'm up on everything apart from Shopify, and that hasn't changed for a while either. 50% down. Of course, don't forget that means I need 100% return to break even on that one. I've got the Pacific excluding Japan. I've got the FTSE 100. I've got Japan. I've got the S&P 500. I've got Aviva, dividend stock in there. Legal in general, that's a European index. Tesla, which is way down. I was 147% up at one point on that stock, but what can you do? It's a long-term hold. So those are the positions that I've got within Hargreaves Lansdown. £11,000 in there. Trading 212 just ticked over £40,000, so that's where my £51,000 came from when we look at the compound interest calculator. So 40,000 in here, 11,000 in Hargreaves Lansdown. This is the investment portfolio I have used for the last 2 years. So I've maxed out the ISA for the last 2 years, which is great. So I've invested 41,384 now. So I have kept Trading 212 for my 23-24 financial year ISA. Cheapest, best one out there. Like the interface. Not going to do a whole breakdown video in terms of all the options out there. For me, this is the best one. You can have individual stocks. You can have fractional shares. It's got all the funds you could possibly want. Good customer services, a secure business, etc., etc. I'm happy to have another year in here. If you do want to sign up to Trading 212, there's a link below. Feel free to use that. You get a free share. And now that I've ticked over £40,000, it's a nice number. £50,000 in here is the next target. We'll do that in the next few months if we think about £2,000 per month getting invested into here. Now, the frustrating thing is, it's just always in the red. Now, I've talked a lot about this is an opportunity to consistently buy and pick up cheaper stocks. And you've got to stay through that, and you've got to keep going. I'm getting a little bit fatigued by it now, to be perfectly honest. I don't know about you guys. But when it drops, like today, it's dropped by like 1.5% or something like that. When it increases so small, day by day, it creeps up, and then all of a sudden, bang, it drops back down again by a couple of percent. So I'm 3% down on this account over the last 2 years since I started investing. Obviously, it's a really bad time to do that, and it is beating the S&P 500, believe it or not, over that time period. And I am every month peaking up cheaper and cheaper stocks as it continues to drop down. Now, we've got some winners and losers in here, and we'll look over those in a sec. Still broken down into the 4 pies. So I've got a dividend pie, which is the best pie in here, 4% up on that. I've got a fund pie, which is 2% down, and I've got a grow pie, which is 21% down nearly, and that's in large part due to my investment into Virgin Galactic, so we'll touch on that in a minute. So within here, I'm going to go over all the stocks quickly, the ones that have made the biggest changes over the last few months, also the sales that I've had. I haven't purchased anything new, so that's the consistent thing that I wanted to do, is not tinker too much. I have sold a couple out, so we'll look at those, but nothing new in here in terms of purchases. So 3M's had a tough time of it, 30% down over the year, 12% down over the last 12 months, but it is pretty reliable dividend payer for me. Comes in every quarter, stable business. I think it's a good opportunity for that one. That was 26% down. A dividend business that's that far down, I don't know. I think it will recover, but we'll see. Alphabet's still down. I think it's got great potential over the coming years. No worries there whatsoever. Amazon, 21% down into this business. I had a look at this the other day, and when you break it down to max, we are where we were pretty much in 2018. This business has barely grown since 2018. 5 years. Despite massive profit and margin year after year. In the last 5 years, if you had invested in this business, a growth business that doesn't pay a dividend, don't forget, 5 years ago, you wouldn't have made a penny. And at times at 10% inflation, it's not easy to see. But I'm relatively happy enough with that. It is a smallish holding in there. The second biggest return, I think, in my portfolio is Apple. Strength to strength. Beautiful big business. Just keeps on growing. How long will it keep doing it for? I don't know. But at the moment, 25% up in there. More than happy. UK businesses have been beaten up over the last few months, it's fair to say. Aviva is down, so is a bit further down. Yeah, Legal in General, look, down 13% now. So a couple of UK businesses struggling. Lloyd's, I was 15-20% up at one point. That now has just crept back into the red, despite earnings out yesterday, which looked pretty bloody fantastic. Far exceeded their profit expectations, but the market just doesn't fancy them. McDonald's, really strong dividend business, 20% up. This is why my dividend pie is doing so well, because my dividend businesses have in general been doing really well. Microsoft is a dividend business, but it's a growth dividend business. Nearly 20% up with that. More than happy with that. Netflix I've talked about before. I won out and I got really close. Let's have a look. At one point, it must have been around here to break even on that. So 319, my average price is 400. So 365, yeah, at which point I wanted to get out. So my average price is far too high on that. I'm just so believing it in the long term. I could be wrong. That's the beauty of this world, isn't it? But I want out when I can. PayPal, massively down, 65%. I want out of that one when I can. Pepsi, love it, doing really well. Realty income ticks in every month, doing okay, down a bit, which is absolutely fine. I'm not worried about that. Rolls-Royce, 50% up. So with the earnings report back in February, absolutely smashed it out the park. The new CEO is doing really well. Global travel is increasing. I don't know if you've tried to buy a plane ticket recently. They've gone up by about 3-fold. Ridiculous. But that is because demand is outstripping supply at the moment, so they can afford to do it. There's even been some CEOs coming out and saying this is a once-in-a-lifetime opportunity for the airline industry. We are going to take advantage of it. So as a result, Rolls-Royce have done well. Now, I did a video back end of last year, said this is going to increase 100%. And it has. So when we look at it over the year, when I did that was about October, November time. Yeah, there we go, 70, and it's 149, so it's increased by 100%. So if you'd invested when I said in that video, you'd have increased your position by 100%. But you know, this could have gone down by 100% as well. That's the problem with these things. Tesla down 25% in this account and still struggling pretty badly. Unilever doing well, 10% up. Another dividend business. It's a UK dividend business, but has global reach. So it's into pretty much every country in the world. So 10% up on that, and it pays a nice quarterly little dividend. Virgin Galactic now. Virgin Galactic has taken a continued pasting. Barely any red. Oh, there's one green when you click on the day, 0.5% up. Oh, it's actually 8% up on the week. Who knew? 11% down on the month, 3% on the 3 months, 43% down on the year, 56% down on the max since it was launched, 72% down on this business. Now, Virgin Orbit has gone out of business at the beginning of this year. That was what Richard Branson was doing when he was sending satellites up into space. This is more commercial air flight. However, I am worried about this one now. I've always said it's a speculative play for me. It could go to zero. It could be the biggest one in my portfolio. Now, I'm leaning more towards it could go to zero. It's just not making enough money. It's not getting enough people up into space, not getting great comms out of the business. It's not getting great earnings. It's getting beaten up left, right, and center in the markets in terms of people's perception of the business. Perception is everything. So I don't know. Are they going to run out of cash soon? Maybe. That one could go to zero. What have I got now? 345 quid is the value of my position in there. I'm £828 down. 70% down. Now, if you were to take that away, 800 quid down, I'd nearly be break even. So this, I'd be a few hundred quid away from break even. So Virgin Galactic is dragging me down. Across Virgin Galactic and Walt Disney. Them two buggers dragging me right down. I'm finishing on Walt Disney now. They're 28% down. 11% down on the year. 8% down on 3 months. 1% up on 1 month. So not great for Walt Disney. They are still making cash though. So I'm relatively comfortable with it. 270 quid down. So all that bearing in mind means I got £40,132 in this account. It's gone down again today. So I got paid a couple of weeks ago. Deposit that in, a couple of grand I think it was. Spiked a bit again. Boom, back down again. Every time I deposit into this account, boom, back down again. Deposit again, boom, back down. Looking further out. Every time you invest and then it drops again. That's the market at the moment. But that's the test now. It's a psychological test of investing into the markets at the moment. It's been the biggest bull run prior to the last 3 years that we've ever seen. And we've seen a decline for 3 years. Now, I've got a relatively short time horizon, 10 years. Are we going to see a recovery over that time? Maybe not. Looking at my deposits that I will do over 10 years, looking back at it, what was it? Total deposits be £328,000 over that time. Could be worth even less than that by that time comes around. But I've got a lot of dividend businesses in here. A lot of businesses that could grow. Some could drop to zero. Now, what have I sold? I mentioned I sold a couple. So I sold Visa. Did that at the beginning of the year. Wanted out of that. And I sold Uber. I sold that just at break even. Again, not making enough money. I don't know. I'm not sure about it in the long term. Not a good enough play for me to be within my portfolio. Both of those businesses are gone. The next two I want gone is Netflix and PayPal. So as soon as we get those two gone, I'll be relatively happy. Now, when we look at the dividend portfolio, started dividend investing back in 2020. By the end of 2020, I had £66. By the end of this is the businesses I held as well. So far too many. I was just picking and choosing. It was right at the top of the hype. 2021, similar sort of businesses, and now I'm up to £156. So double my money from 2020 to 2021. 2022, I was up to £470, and this is when I've consolidated my positions. And pretty much all of these I now have, with the exception of Visa. Don't have that one. Mention that. And then 2023, same holdings again. We are up to April. It's been a quiet first quarter in reality, but I've already got 122 quid, £69 in my businesses and £52 in my funds. Now, this number down at the bottom, I've taken a steer from Paul Briscoe. I don't know if you follow him. Check him out. He's got a great channel. But what he does is he works out what his dividends would do as a salary. So if you think about it, over the course of a month, there's 162 hours. So look at the equation. 162.5 working hours on a 38-hour contract. Can't remember what it was. 37.5-hour contract or whatever it is. So if I just got paid by my dividends, I would have got in January 9 pence an hour. I would have got in February 4 pence an hour. In March, 33 pence an hour, and in April, 29 pence an hour. So obviously not enough to retire on yet, but it's great to track that. And when we look as an average over the course of the last year, on average, it was about 24 pence an hour. So I'm going to continue to track that. When we get up to a point where we're at minimum wage, I think that'll be pretty awesome. When we're up to a point when we get to £1, I think that'll be pretty awesome. So I've got some big months coming up for a lot of UK business I've got in here. I've got a big position within Legal and General, and that's going to pay 100 odd quid. Lloyd's is going to pay a few quid. Aviva's going to pay a few quid. All coming in May. So hopefully we'll have a decent month in May, break 3 figures. That's what the plan is anyway. And I'm going to continue to invest in those dividend businesses. I do love dividends. It's the best bit for me about investing is looking at those numbers go up. Seeing that transaction come in, reinvesting it. Every penny I've ever made has been reinvested. So yeah, really happy with that. Now, if you have watched the channel for a while and you want to know where I've been, it's pretty simple. I've just taken a few months out, to be honest. Nothing going on, nothing major. I've been working hard at the day job. Don't forget, I've talked about this before. There's nothing wrong with a day job. Pays pretty well, enables me to do this. Not a penny I've invested has come from money from YouTube, mainly because I've barely made anything from it. So when you're my size, there isn't much money to be made on YouTube, and that's one of the reasons why I slowed it down, to be honest, as well. So I started a couple of years ago, got up to 2,800 subscribers now. Worked really hard at it, thrown loads of hours at it, and really enjoyed it. I mean, I still really do enjoy it now, but it was also the reason we do, or the reason anyone does any of these channels, is to make a few quid as well. And the return on investment in terms of the amount of effort that goes into making these things versus the amount of money I've made just started not to stack up. So my approach now is, I've always said I'm going to track this portfolio to reaching financial independence over the next 10 years. I'll do that. So if you're interested in continuing to following that journey, seeing what I buy, seeing how I'm doing, the reasons I buy things, the reasons I sell things, etc., continue to follow it. But I'm not going to be doing 2 a week. I'm probably not even going to be doing 1 a week. I'll just do it when I can be bothered. In all honesty, sounds pretty bad, doesn't it? But what that means is I'm really not in it to try and make any money now. I've given up on that. So it is just document my journey. If you're interested in joining along, you're more than welcome. With that in mind, thanks for watching today. Next video will be out God knows when I find myself another few hours to do it. But here we are.